if I don't click record now, I will forget. Students, if you are able to, please turn your cameras on. If not, no big deal. I want to thank everyone for being here tonight. My name is Becky, and I am a career counselor in the Center for Career Development. I work with students who are interested in business consulting and finance, so I know most of these students. We have 5 panelists with us tonight, which we are really excited to learn from them. This is an idea for an event that we've had for a really long time, so we're really happy that it can happen tonight. I also want to thank the students for being here. It is the day after spring break and it is the day before a snow day. So I know that this is probably a little bit of a challenge, but I hope that this is really engaging and we really appreciate you being here. At any point during this discussion, students, you can pop questions right into the chat and we can kind of popcorn around and answer them. We also will share the contact information of all the panelists and a few panelists who are actually unable to join us tonight. You'll get an email after the session. So without further ado, we will get started. We're going to have our 5 panelists introduce themselves with their name, class year, major, and current role. So that's your name, your class year, your major, and your current role. And we'll get started with Kelly, please.
Hi, everyone. I'm Kelly Shaw. I was Holy Cross, class of 2009. I majored in economics and Spanish, and I'm currently an early stage fintech investor with Vestigo Ventures.
Thanks. Moving on to Ryan.
Yep. Hi, everyone. And Becky, thanks so much for having us. Ryan McGrath, I'm class of 2014, where I was a political science major. And I work at General Atlantic, which I've been here for about 3 weeks now. Prior to that, I spent the last almost 4 years at KKR.
Awesome. Thanks, Ryan. Moving on to Michael.
Hey, how's it going? I'm class of 2017. I was an accounting major, and I'm on the capital raising team at EQT Partners, a Swedish-based private equity firm.
Awesome. Jay?
Hey, everybody. Great to meet you. My name is Jay Mackey. I'm class of 2019. I'm an associate at Kohlberg & Company, which is a private equity firm based in New York. It's great to see so many people join the call. I'm excited to have you guys interested in these spaces.
That's great. And Joe.
Hey, everybody. I'm Joe Darcy. I'm class of 2011 from Holy Cross. I was an economics major in undergrad, and I currently am, the title is investment manager, but I'm a venture capitalist with Volvo Group's corporate venture capital arm.
Great. Thank you. So now that you've shared your roles and your majors, I think students are probably wondering what a little bit more depth is to your roles. So we're going to go in the same order. Can you please describe what you do? What are some of your responsibilities and what does your day really look like? So we'll start with Kelly.
Sure. So essentially, I'm tasked with finding the best startups in the fintech ecosystem and essentially investing in them. So we're usually investing at the seed stage, which means the startup might have a small amount of revenue. Sometimes they don't. They typically have a product, and we are, looking for a unicorn. And so we're trying to underwrite to 100 million plus revenue. And what that means for my day-to-day is a lot of Zoom calls or coffee chats where I'm meeting a variety of different founders, venture capitalists, or others in my network who might kind of know of companies or founders that are interesting to meet. Another portion of my day might be spent managing some of our portfolio companies. And so that is attending board meetings, that is having calls on sales strategies, or even networking on their behalf. So we might be talking to banks or RLPs about opportunities within our portfolio for them to connect commercially. And then other parts of that, when we're looking at a deal, is diligence. And so that is typically an analysis around the founders, who they are, why we think they'll win, the market, some of maybe their kind of early traction, if they have any, as well as the overall technology.
Awesome. Thank you, Kelly. Ryan?
Yes. So I'm a fundraiser. So if you think about the 2 most fundamental businesses or roles within private equity or venture capital, you've got investment team members or deal team members like Kelly, like Jay, like Joe, And then you've got folks that are going out and engaging with limited partners or institutional investors to go out and raise capital to then be invested or be deployed by the investment or deal teams, which is very similar to Mike, not to steal your thunder, but I know what you do. Very similar to what Mike does as well at EQT. So my day-to-day is engaging with prospective limited partners or prospective institutional investors, as well as our current investors, to help articulate our particular General Atlantic's strategy, sentiment towards the marketplace, ultimately in the hopes of going out and raising capital on their behalf to be invested by General Atlantic, which is a global growth equity firm. So if you think about kind of the life cycle of a business or a life cycle of a private equity firm, you've got very early venture capitalists, which is kind of where Kelly is predominantly focused. You've got on the other end of the spectrum, very mature businesses that are subject to leveraged buyouts or LBOs, as you guys are maybe familiar with. Somewhere in between the middle there, you have what's called growth equity. So we are typically the second or third institutional investors in a series kind of B through F round, typically. So investing after where Kelly is investing, ultimately in the hopes of working with founders, entrepreneurs, and existing management teams to help them grow through various inflection points in their business's life cycle prior to a sale, whether that be to the public markets in an IPO or to a strategic acquire another business in their field or another much larger private equity firm. So in terms of my day-to-day, I'm engaging with investors around the world, again, kind of articulating General Atlantic's value proposition, working with our existing LPs as well, to at the end of the day, raise capital for General Atlantic.
That's really helpful. Thank you, Ryan. Michael?
Yeah, so I could mimic a lot of what Ryan said. We're in very similar paths, but I think a difference with EQT is there's a broad suite of products that we're trying to sell. So I'd say we're more of salesmen than I guess more of on the investment side. So I'm just trying to find the right niche for the different investors and trying to bucket them into where they might fall in. So EQT has a fall under their private capital sleeve. There's a ventures fund, there's a growth fund, there's a private equity fund, there's an Asian fund. So there's a lot of different products that we're looking to sell. So I think a lot of it's trying to find if we can cross sell, if we can find the right investor for EQT and then kind of manage that relationship. So there's a lot of client servicing that goes in with it as well. So managing the relationship. I think as a more junior level person than Ryan, I think there's a lot of putting together bespoke presentations for different investors and trying to prove why our different products might be best fit for them. And yeah, so that's I guess mimicking a lot of what Ryan said, but pretty similar.
Great. Thanks, Michael. Moving on to Jay.
Yeah, thanks. I also think I forgot to tell you my major. So I was a math and economics major for you guys. And so Ryan kind of touched on it, but what Kohlberg does is leverage buyout private equity. So we're really focused on buying a control stake in a company, improving the company, whether it's through accelerating their growth, shifting their strategy, or sort of optimizing their cost structure. So those are really kind of the three levers that you would see in private equity when you're doing leverage buyouts. And the whole goal is just to own the company for a period of 5 to 7 years and then sell it for a profit at the end. So my day-to-day, like for example, today, I'll just tell you what I did today. So today usually would come in the morning, get through whatever work is left over from either Friday or over the weekend. Then on Mondays, we'll have an investment committee meeting. So today, my team, who's the pharma team at Kohlberg, actually presented a new deal to the entire firm where we basically walked through, how we were structuring the deal, what the investment merits are, what our plan would be to do with the company post-close, how are we going to fund the deal? So what fund are we drawing from? So similar to what Ryan would be raising the funds that we'd be using to deploy, like he said. And then later in the day, it's probably just more calls. And then after this call, probably a little bit of work and then do it again the next day. So that's sort of my day-to-day as someone who's a little bit lower in seniority on the investment team.
Thanks, Jay. That's really helpful. And Joe.
Yeah, so I'm in one sense, guys, I do a fairly similar role to Kelly. Call it 80% of my job is finding and ultimately selecting, call it 4 to 6 new startups to invest in a given year. And to put in perspective the ratio there, in early stage investing, we're meeting with or considering about 1,600 startups to get to 4 to 5 decisions. Pretty high volume, low win rate in terms of what we're actually succeeding in. Where we differ a little bit, though, is being at a corporate venture capital firm, a couple of key differences. The first is that whose money are we ultimately investing? And the way that a venture capital investment works is pretty simple. You write a check to a founder or to a business to buy somewhere at or south of about 20 to 30% of the business, typically more like 5 to 10 for an individual investor. Whereas Kelly is investing or buying those portions of companies with a collection of up to 100 investors. That can be people, institutions, et cetera's money. I have one person's money who I'm investing in, that is Volvo Group, the large trucking manufacturer headquartered over in Sweden. Grossly oversimplifying things here, but again, cut a check in exchange for ownership of a company. Where it's also a little bit different for me, and I say 80% of my job, whereas Kelly's is pretty much 100% of her job. And I'm only picking on you, Kelly, because A, I know you the best, and B, you're also the VC, or the early stage VC, is she's spending the vast majority of her time on the investing side. On my side, I'm also working with our different internal corporate. I mean, it's a 100,000 person company, so there's all kinds of nooks and crannies. And so there's a little bit of that strategic perspective of making sure that the wants, needs, desires of people building, designing, selling, manufacturing trucks are also being served by the role of startups. So putting a bow on it in terms of, what do I do on a day-to-day basis? I try to organize my weeks as much as possible like this. Monday and Tuesday, I am back to back from 8 or 9 a.m. in the morning until 5, 6 p.m. at night, talking with either founders of companies or other investors, either to learn about those businesses or exchanging ideas with those investors of who are other interesting companies that we might want to invest in. Wednesdays are spent just with my team. How do we get from that 1,600 down to that 4 to 5 and managing a funnel accordingly, which is why I'm moving my hands like this. And kind of layering down and distilling down into which companies we ultimately want to invest in. Thursdays, I go into our North American corporate headquarters, which are down here in North Carolina, and a lot of meeting with different people in the business units and understanding, again, what are their wants and needs, and then on the flip side, introducing them to startups that I think might be interesting for them, which it's a win-win. They meet cool and interesting new companies that are doing things they can't, and startups ultimately have a good partner that can help them to grow. And then Fridays, I try to keep my calendar completely clear and just do a ton of reading, research, reviewing whatever materials the founders have provided to me. That can be financial models, VC and early stage venture investing, which we're doing Series A and later investments, typically where a company is going from maybe 10 employees up to about 100 in the next 12 to 18 months. It's a lot of art and science, understanding macro level about markets, micro level about these individual businesses, and so on and so forth. So in short, VCs are extremely this interesting balance of, we love to talk. We spend a ton of time talking with people, learning from other folks, reading and digesting whatever we can, this weird balance of quantitative and qualitative, introverted and extroverted. That's kind of what our day-to-day looks like, but a large part of it, Zoom has been the best and worst thing for the venture capital lifestyle.
Fantastic. Thanks, Joe. I'm sure a lot of students are listening in and thinking, wow, I really want to be in your shoes someday. Can you walk us through how you got from Holy Cross to your current role? We can popcorn around, so whoever wants to start, just hop off mute and chime in.
I'm happy to start because I'm the youngest, I think, on the panel. So I originally started as a math major, like I mentioned to you guys. I thought at the time, I think they still have the program, they had this 3-2 engineering program. with Columbia at Holy Cross. So I thought that's what I wanted to do when I joined. And then my freshman summer, I actually took an internship in the corporate finance department at Time Warner. I'd gotten it through, played on the hockey team at Holy Cross. Some older hockey guy helped me get the job. And that summer, AT&T bought Time Warner, which was a really big deal in the media space at the time. That got me interested in investment banking. So when I went back to school, I decided I'd add the economics major, which looking back on it, I probably didn't need to do because I had no free time in college. But I decided I wanted to pivot and potentially do finance. So I started looking at finance internships. Eventually in my junior year, got a job at Barclays in investment banking, and really enjoyed that. And it was really with that first experience from my internship at Time Warner that made me interested in finance. So that was kind of my path. And then eventually, once I got into investment banking, I learned about private equity. It's a pretty common jump, and I'm sure a lot of you guys have heard about this, to start in investment banking and then move over to private equity. So I joined a startup private equity firm out in San Francisco, actually, and lived there. I lived a year in New York after college and then 2 years in San Francisco. Got to join a startup private equity firm who was actually started by Holy Cross alumni as well. And then decided to make the switch back to come back to New York and join Kohlberg about 5 months ago. So that was my path.
Thanks, Jay.
Yeah, I think my two biggest pieces of advice, and Becky, to your question of how did I get into the different roles that I did, the short version is I spent the better part of a decade working in New York on Wall Street in various different forms and functions, and then realized I wanted to go earlier on in the company life cycle. I went back and got my MBA, which is what brought me down to North Carolina, and was fully expecting 2 years down in the Southeast, get a good degree, work on the golf game, and then back up to New York or out to San Francisco, because I thought that those were the only two places that VCs lived. And I guess tangentially Boston as well, with my Holy Cross roots and family ties up there. In reality, just got more and more entrenched into the broader national venture capital market, and have spent now over 5 years here in North Carolina. So I'm still based down here. I think putting it differently is, I remember when I was in your guys' shoes, to all the students, and I had no idea what I wanted to do. When I graduated, and I had not done nearly enough career exploration and didn't know where to begin. And so in one sense, from day one, in another sense, it's carried me through to this role at Volvo that I started at the beginning of this year. And it's just talking to people, get to know them, develop genuine relationships. Ryan, I remember sitting next to you at dinner at one point in New York years and years ago. Kelly, we reconnected because we saw Holy Cross, especially being Crusaders. It's such a tight-knit ecosystem that, you know, pretty much you have that .edu email address is a really powerful tool. Just get to know people on the personal level. Jay, I hear you played hockey. I played club hockey. We had just as much fun without all the requirements that you guys had on varsity. But I digress. It's that level of just getting to know people and developing those relationships that will help you in ways that you have no idea now, and will never realize until you look back and play back that story in reverse. So my biggest piece of advice in terms of how to navigate our career search is just focus on getting to know people, listen to their stories, and use 2 ears and 1 mouth in that order, but use both, have a voice, contribute, be really genuine, and it will take you everywhere that you need to go in terms of your career path. So that's my biggest piece of advice. And I think the final point that I'll put on that is, as well, we're throwing out a whole bunch of different terms and phrases, and LBO this and venture capital that, and so on and so forth. The last thing I'll add is, at the end of the day, every single business, no matter what it is, can be broken down into really simplistic. You build something, or you offer a service and you sell it, and you hope that you make money in the process. And you can break down anything into those simple widgets. When you think back to being a kid, were you more of a math person or a science person, or did you like reading and painting pictures and so on and so forth? Any career, and that's why I say lead with just getting to know people on a personal level. You'll be able to get that clarity and break any job, investment banking, accounting, venture capital, healthcare, you name it, into that. You build something and you sell it. That's every single business out there.
That's really great advice. Thanks, Joe.
I can hop in as well, just because I think I had a pretty irregular path to this part. So I actually started in accounting. I took the normal route there and did public accounting. I did audit at Ernst & Young, and then got to working with the valuations team there, and kind of knew early on I didn't want to do accounting long term. I wanted to be in something more client facing and client forward. So kind of took a long search, took like a year to really figure out what I wanted to do. I met with people like Ryan, met with Ryan for a beer, just asked a lot of questions and kind of figured out where my strengths were and where I wanted to go. And thought that, investor relations / fundraising was a good combination of the analytical ability I built up in accounting and what I wanted to do from more of a relationship driven side. So I actually got very lucky just through networking. I met with someone who used to work with my aunt who recognized my last name, and that got my foot in the door. And then ended up playing paddle tennis with someone else at EQT. And then that's how I just stayed in touch with that guy and asked a lot of questions, similar to what Joe said, just getting to know people on a personal level. And then kind of made my way over to EQT, so over to a bigger firm. So it's really come a lot through just like reflecting on what I thought I was good at, and then asking questions on how I got to that point in my career, and figuring out what that career path was. Because I knew early on accounting wasn't it. So really just kind of took a journey to figure out what I wanted to do and what I thought I'd be good at. So that's kind of here I am now. But like Joe said, I think asking a ton of questions and meeting with people on a personal level, everyone's always here to help. I know I bugged a lot of Holy Cross people when I was looking to make the career switch and transition, and everyone was super helpful and responsive. So definitely having that .edu holds a lot of weight. So always feel free to reach out.
Thanks, Michael.
Yeah, I think quickly, look, not to be redundant, but would certainly echo everything that's been said thus far as it relates to the importance of leveraging this incredibly valuable network that we all share and love. Just to give a quick summary of kind of my experience, I very much got my first job via Holy Cross connections that was fortunate enough to be able to leverage. During going into, I guess, the summer of my junior year, was interviewing for investment banking jobs, had interviews with and got a job at Morgan Stanley from another Holy Cross alumni, a relatively young alumni, who throughout that interview process connected me actually with his father, who happened to be a grad of his class of 72, who was a senior executive in the capital markets business at UBS. And I was fortunate enough to spend some time with him. Ultimately ended up turning down the opportunity to go to Morgan Stanley to go work specifically for this Holy Cross alum at UBS, who's now long retired. But I spent the first 2 years at UBS in what's called their graduate talent program, which is a really unique 2-year rotational program across bank businesses. So I spent time in the investment bank and their asset management business, as well as their wealth management business, really as a 2-year kind of road trip through the varying corners of financial services. Ultimately decided that I wanted to focus on the investment management side, specifically the buy side. So think private equity, hedge funds, et cetera. So I worked in UBS's alternative investments business for about 4 years thereafter, before I had the opportunity to join KKR, which, as I mentioned, I was there for the last little over 3 years before making the move over to General Atlantic. But I think, point being to emphasize the fact that this is a tremendously valuable network that we're all fortunate enough to be a part of, and can't emphasize enough the importance of really leveraging that, taking advantage of that, and doing so very thoughtfully. Be smart about the folks that you're speaking to, about the questions that you're asking, to really develop, kind of your own framework and roadmap that you think might be most helpful to you as you think about, starting your career and navigating it thereafter.
Thanks, Ryan. Anything you want to add, Kelly?
Yeah, as the person with maybe the longest career or the furthest out from Holy Cross, I think what I would add is I was probably relatively naive about what was under the finance umbrella. But my guiding principles were kind of always to go with what felt right for me, not just from a job content standpoint, but also kind of that intersection of geography, of culture, of also learning. I've always been a curious person, and I've definitely emphasized making sure that I was learning throughout my career. And so I, as I mentioned, graduated in 2009, which was the Great Recession, and had actually had opportunities with Goldman Sachs and GE during the internships. And everybody told me I was stupid and crazy, but I actually went with GE at the time, enjoyed their FMP program, and kind of what guided me there was I was very interested in learning and wanted somebody who was really going to focus on developing both hard and soft skills. And that was a core component of GE's financial management program, was building kind of the next CFO leadership. And so that was interesting to me. Also, the fact that it was rotational. And so I got to try out different things. You also had the opportunity to go international, with just at the time, GE's definitely changed very significantly for the time how different it was. And so I ended up spending time in Spain and Italy, and I'm an EU citizen, and kind of international exposure has always been important to me. So to start, I had no idea what venture capital was. I'd never heard of it. It was not on my radar, but I'd kind of made choices throughout my career around getting more strategic or being involved in bigger decisions. I'd done M&A at GE Capital, worked on actually the divestitures of the bulk of GE Capital, so about 200 billion in assets, and then parlayed that into a corp dev role at Synchrony. And so at Synchrony, which was a spin out of GE, I was investing or acquiring fintech startups. And so that was my first kind of joined without actually realizing I was going to be doing venture capital things. And I just fell in love with it. As I mentioned, I've always prioritized learning. As a VC, you're always learning. Curiosity is kind of the name of the game. And so similar to Joe, I realized, you know what, I really want to go down this VC path, and how do I do that in a much deeper way? And so I was kind of told, go and either get an MBA or be a founder. And I actually did both. So I'd co-founded a fintech startup, and then I also went to Harvard Business School, and then similar to what everybody else said, networked a lot, and met Vestigo where I am, and kind of stayed on here in Boston.
Awesome. Thanks, Kelly. So students, I think there are really two major takeaways from all of their responses. One is your first job is not your forever job. So don't put too much pressure on it, but instead make the most of it, and you can grow from it. And then second is that networking never stops. And your Holy Cross degree and that network is going to serve you really forever to make the most of it. So thank you everyone for sharing. At this point, it is 7:30. So I just want to remind students that if you have any questions, please put them in the chat. You can send them to everyone or to me individually. If not, I will keep running through my questions. So questions in the chat at any point, and we will shift gears a little bit. So my next question is, what are some current trends that have impacted your work? These could be related to COVID, technology, market trends, really anything. So what are some of the current trends that have impacted your work? And anyone can chime in here.
I can start. I would certainly say, well, there's no shortage of things impacting what we do on a day-to-day basis these days. But I think, maybe perhaps a long-term, more secular trend. Certainly we all had to evolve very meaningfully during COVID to adjust to a working from home environment, and traveling stopped for the most part. I mean, prior to COVID, I was constantly on the road, meeting with prospective and current investors. I think during COVID, we all learned very quickly that we can accomplish a lot over Zoom as well. And so travel has significantly been curbed, at least for me, and I think other peers of mine with similar seats. I think General Atlantic and KKR both were 5 days a week back in the office, which I know is not the case for most. So I certainly personally can attest to kind of some of the broader trends in work from home versus in office environments. But I would say that kind of business travel has significantly been reduced, kind of during and in the aftermath of COVID from my perspective.
Anyone else seeing any trends that they want to share?
I mean, this is one that I don't know how much it's impacting my day-to-day job, but it is definitely impacting how we think about investing, is just the rise of AI. And that's not necessarily just the ChatGPT and all the noise there, but as fintech investors, we think about the role of ML and AI in kind of the future of financial services and insurance. And then we also think about the role that can play as well in our own jobs. So we have data scientists on our team. We do a good amount of deal sourcing via algorithms that are running in the background based on kind of consumer web and email traffic data that we have. And so we're continuously thinking through the ways that we can incorporate more and more data to essentially kind of increase both the net, and so the companies that we're discovering, but also the ways that we evaluate them.
Thank you, Kelly and Ryan. We'll start with David's question in the chat here. He said, how do you think the collapse of Silicon Valley Bank will affect the startup market? And what is the response that will come from that in your own personal company?
Well, I can jump in here as well and just start by saying, look, it's a tremendously fluid and active situation still, and it's going to be tremendously fluid and active for at least the next week or so. So I think the long-term residual implications are still very much to be determined. I think the regulators certainly helped late yesterday evening by stepping in and providing, at least for now, a backstop to protect depositors and creditors. But I think, it's a very, very unique circumstance, not to get into the details, but I think, long story short, it's still very, very early to tell what kind of long-term residual implications look like. And hopefully it's not at the expense of other non-GSIB regional banks. But it's definitely still a fluid and active situation.
Yeah, David, it's a great question. And I think kind of putting on my Holy Cross hat twofold. One, spinning your question a little differently, what do I hope happens? I hope that a lot of people involved in the broader startup ecosystem, both founders and more importantly funders, do a lot of self-reflection into how they've acted in the last not only week or so, but farther beyond that. And I'm not trying to pass the blame on any one group more than the other, nor absolve anybody, because there's a lot of things that have gone on there. Second Holy Cross thing I'll say is that I have dusted off my political economy and textbooks more in the last 72 hours, trying to explain to a team that's exclusively in Sweden and doesn't fully know the ins and outs of the American banking system, more than I would have expected. I graduated 12 years ago from Holy Cross. So if any of you have Professor Justin Speck, thank him, because my notes have come in very handy as I've explained how the American banking system works to a group of Swedes. All joking aside, I think in terms of what is going to happen, I agree with Ryan that it's way too early to tell, but there's the objective aspects of the Silicon Valley Bank collapse that I think are beginning to and will continue to be addressed, whether it's the change back from a regulatory perspective to having more safeguards in place for bank deposits and what a bank run in 2023 could occur, and thinking about that side of things, or whether it's the Fed's pace of interest rate increases. But then we get to the subjective side of things, which is VCs. I mean, Twitter was insane over the last week. And a lot of this entire thing could have been prevented if it weren't for subjective irrational behavior by a lot of different stakeholders involved in this whole situation. Similarly, in terms of, in venture capital land, about 12 months ago, everyone was shocked overnight when founders were being advised to cut burn immediately, and yet cash was flowing hand over fist into startups for quite a few, 12, 18, 24 months. Obviously, there was inflationary pressure going into the ecosystem. Similarly, we were at historically low 0% interest rates for a long time. Inevitably, those rates were going to go up from the Fed. That's how it fundamentally functions. And so subjectively, I don't know. I hope that people learn from this and the amount of risk that was incurred, and just assuming things will, work themselves out. But coming back to it in one sense, we don't know the full extent of this. But I hope that a lot of people are doing some soul searching. So that's my take on Silicon Valley Bank.
Awesome.
I have a bit of a different perspective to Joe, which is, well, first off, I never thought I'd be part of a bank run. But I think that the way VCs acted was frankly relatively rational from a prisoner's dilemma standpoint. The risk of your portfolio, we had portfolio companies with all of their cash in SVB, and the risk of them losing that cash and being unable to run versus the reward, which was the status quo of just having their money be available, was, too much than we felt comfortable with. And so we were maybe some of the earlier ones to suggest that our founders take money out. And I personally think that SVB could have done a much better job in terms of providing the confidence in the market so that that did not happen. I do think that there is a lot of fear mongering going on right now that is creating a lot of skittishness across other banks. And so I do hope that the contagion does not spread. I think SVB probably would have been fine if the bank runs did not happen, but just the way I listened to their calls and their comms, and I think we felt very, very uncomfortable with the way it was being treated and what others were going to do in terms of actions. In terms of kind of post all of this, I agree with the sentiment that we still need to see the dust settle. I'm a bit concerned about those who had credit facilities. This is more from like a fintech startup ecosystem. And so what does that mean for their ability to operate their companies? How quickly can they kind of get set up with other banks? Will banks be willing to take on kind of more venture type debt? The other issue is, we're actively thinking through our startups who are selling into other startups, and what does that mean for them? So there are a number of risks right now in the market. I think we'll see how far and wide that extends, and we'll kind of only know over the coming months.
And then one last thing, and to dial it back to where you guys were, and like I've said in my remarks on career exploration, you guys, even attending a session like this, are way ahead of where I was when I was in your shoes. Kelly, great points, and I ultimately agree with the vast majority of what you said. So as much as we originally approached it from two different perspectives, I actually you convinced me on some of those points. And to bring it to where you guys are at in your journey of exploring VC specifically as compared to, say, the LBO guys and investment banking and so on and so forth. These are exactly the types of conversations, and just that conversations that VCs are having amongst each other in terms of understanding what the lifestyle is like in the venture capital industry. You take counterpoints of your peers, you argue them, you beat these ideas up, you're thinking about macro level trends, micro level, how is this startup going to make payroll a week from today? All of those different perspectives, and you're having conversations just like this back and forth. Sometimes they get a little heated, other times they don't, but just in terms of, again, you reflecting on as a person and as a current Holy Cross student and thinking about your career, do you like having those sorts of debates? Are you someone that doesn't like and wants to just be more in the numbers, which is totally fine too? Different aspects of the career paths accordingly. So just wanted to highlight that and bring it down to the actual function. This is a really good example of how VCs work on a day-to-day basis of two counterpoints.
Awesome. Thanks, Joe and Kelly. We'll move on to another question. So I think it makes sense to actually skip down to Thomas's question, which is, how have the recent rate hikes affected the valuations of startups, and has it taken a toll on deal flow?
I can jump in. So from an early stage Also, our fund itself, we were not super active in 2021. We saw valuation skyrocketing, and we actually only invested in 2 companies. We were more active last year as we saw valuations rationalize. And so we personally see 2021 as kind of the blip, whereas I know a lot of founders are kind of hoping things go back to 2021 type numbers. The way we think about deal flow now, we are still, I mean, early stage was not hit anywhere near as hard as growth, but we are still seeing valuations come down a little bit. We are seeing expectations coming down as well. I think we definitely are much more thoughtful around like, what does it take to raise a Series A or the next round when we're investing? And so do we think that they're raising enough capital to get them there with some level of a buffer? And so I think the goalpost has just kind of moved in terms of what fundamentals you need for subsequent rounds. And then in terms of deal flow, we all want to invest. I think we're seeing the same volume on we're not seeing the same quality. And I've heard that echoed across kind of other VC friends at the early stage. And so I do think that a lot of founders, particularly the top-notch founders, are kind of holding back if they can on raising rounds until kind of the world normalizes, or they're frankly forced to raise a round.
I can sort of add some thoughts on the private equity space, because I think that's probably been impacted more than VC just by the nature of the type of investing that we're doing. So when we're talking about leveraged buyout, the word leverage in it means debt. So when we're going to buy a company out, we're raising a lot of debt alongside the piece of the fund that we're going to invest. So if you can imagine, if interest rates are going up, the cost of debt is going up by a lot. So whenever we buy a company, you'll run it through a model, right? You'll say, I think the company is going to grow X amount over the next 5 years. I can buy it with a piece of my fund and a bunch of debt that I'm going to raise, and I think it'll generate this return. That's basically how private equity works. So if you have interest rates going up, the cost of debt's going up. So all your interest payments are going to be more expensive for the same amount of debt, all else equal. So for us, what that means is we can't pay as much for any given company. And if you can imagine you're a seller, you've seen someone else pay, let's call it 5 times your earnings last year in 2021, like Kelly alluded to. And now all these buyers basically can't pay as much for your company because the cost of debt is higher. So what the result of that is a lot less deals get done. Because if you're the person selling your company, you don't want to sell right now because you can't get as much money for it. And if you're the person buying the company, you can't raise as much money to generate the same return because the debt's more expensive. So that's kind of how it ends up impacting private equity deal making.
Just to add on to what Jay's saying there too, I think from a capital raising standpoint, we're trying to find different ways where we can leverage this, leverage the higher rates. So I think right now what we've been doing, it's been a lot harder to complete these mega deals. So we've been going out to our investors and looking for co-investments, which is when they come in with no fee or no carry. So it's a good way to partner with our different LPs and let them come in and kind of and when they put it into their model, it essentially brings the fee that they're paying down. And then so they can come in on a deal by deal basis, and it'll kind of show them how we work through a different deal process and really strengthen the relationship. So I think there's a lot more co-investment opportunities for investors out there. And that's kind of what we're looking to do to battle, the financing difficulties that we're having right now.
Awesome. Thanks, everyone. Moving on we have some questions from Ryan and Jack. I think they go hand in hand. So Ryan asks, is it encouraged to have a job in a different area of finance before going into VC? And similarly, Jack asked opinions on the jump from consulting to the buy side. And are there any recommendations of other internships and jobs that are not in investment banking that can lead to the buy side? So wide range of questions here.
I can jump in on the VC side. From an undergrad to VC perspective, there's definitely opportunities. And the way I guess I would think about the career there, if you do jump directly in, is that from my perspective, you would eventually want to leave. And what I would leave to do is frankly join a startup, particularly at the early stage. I think if you cannot get a job in VC directly out of school, I would frankly also join a startup. And the reasons for that is I think that joining a startup prior to being at VC gives you a significant amount of learning of what it means to actually be at a startup. Also a lot of empathy for what founders are going through and helping them when you're a VC, because a significant part of being a venture capitalist is helping guide your portfolio companies. And often founders, it gives you a lot more credibility, and founders really like that you can empathize, you can have ideas, you can have strategies. You're not just some VC who's kind of never been in the trenches. So I do think having that experience is important. I think I'm an example, Joe's an example that you can also go into other areas of finance and eventually make your way into VC. But I think if I known about VC as an undergrad and was going to jump into it, I'd probably go and join a startup and work there for a number of years, and then maybe try to jump into an associate or senior associate role, or go get an MBA and jump back in, or be a founder or something there. And I'll let Joe jump in if he disagrees.
No, this time we agree, Kelly.
Okay.
No, I think the only other points to add in terms of the VC side of things are, first of all, kind of two sides of the same coin. In one sense, Becky, you asked earlier about trends that have impacted our job and our career. I think it's for the better that where you're building a company or where you are an investor means a lot less in many ways than it did pre-pandemic, because the culture of Silicon Valley is very different from the culture of Boston, which is different from the culture of North Carolina. At risk of stating the obvious in terms of obvious lifestyle differences, but in terms of how investors think, how investors invest, what they value is very different. And that's on one side of the coin. But the other side of the coin is still in terms of career management, the expectations of what your background is. I would say that regional difference still exists. Broadly speaking, there's a lot more ex-investment bankers running around the Midwest that have converted into VCs. Silicon Valley, in my experience, prioritizes operating experience. New York's a little bit of a mixed bag in a good way. Of you have, much like the city, you have some ex-bankers, consultants, startup people, actors and actresses, you name it, and it's kind of a melting pot within New York. So I think there's no one path within venture capital. Do be aware of what the culture is in different markets, because I do think that impacts where some more typical career paths can lead. But at the end of the day, boiling down venture recruiting, in my opinion, what are we looking for? We're looking for people that are hungry, going to work hard, and ultimately can add value to my team in one way, shape, or form, and that their past experience or experiences can help to either fill a gap that I need or to unveil an entirely different gap in my business that I didn't know beforehand. So that's why there's so many investment bankers that eventually go into venture capital or private equity as analysts if you go the undergrad route without going through an MBA or having that startup experience, because you're filling the gap on the financial modeling piece. And we know you can do models in your sleep if you've been trained at Goldman, JP Morgan, et cetera, et cetera. On the flip side, part of the reason that it's often thought about of needing to have operating experience to go be a VC is like what Kelly said. You understand and empathize with the founders as you're working with them post-investment, and also have a built-in network of investors to play in. So I guess in summary, do you need to have a specific background to get into venture capital and finance? No, but I do encourage you, as you navigate your career at VC as the end goal, to think about and really reflect upon how does my unique collection of experiences and what I've been doing on a day-to-day basis help a venture capital firm, and know that you can pitch yourself and you can find somewhere to plug that gap in that specific firm pretty effectively by going through all the different steps that we've been talking about in this process. But that's saying at more of a macro level, like I said, different regions will have different priorities in terms of what they're looking for in backgrounds.
Maybe, I mean, Joe kind of alluded to it, but I would say private equity probably is a little bit more of a strict pipeline just by the nature of the business. So that's not being said you can't be in investment banking. But I would say 80% of people likely come from investment banking, and that's probably because we more heavily rely on financial modeling at the private equity level. So that's just a skill that you would need to have. There are people that come from consulting, usually big four consulting firms. So think like McKinsey, Bain, BCG, whatever. I guess it's the big three. So those are typically the skill sets, and not everyone starts there, but some end up getting into investment banking and then private equity. I would say that's typically the path. So while you don't have to start there, it'd be good to orient yourself in one of those roles eventually if you're interested, I would say.
And there are PE groups within the consulting firms.
Yeah, that's a good point too. Yeah.
Thanks all. Any other comments about the questions that we've asked? Okay,
I think Joe, Kelly, and Jay did an excellent job covering it. I have nothing valuable to add.
great. Well, we have just a few more minutes left, so I want to just encourage students, if you have any final questions, to pop them in the chat. And then for our alumni, if you have any final thoughts or pieces of advice that you didn't have a chance to share, now would be a great time to do so. If not, we'll hop off a few minutes early.
I'll add one more thing, guys. I think we can't just emphasize enough how much you should leverage your the Holy Cross network. So Ryan will remember this, but when I was that sophomore internship at Time Warner, I remember I messaged like Holy Cross people every day. I was the most annoying person in the world, like asking people to go out for coffee, beer, like whatever. I didn't know what the heck I was doing. I didn't know anything about finance. And really those conversations are how you learn. I mean, you can read a textbook, but hearing about people's experiences are really what's gonna help you figure out what you want to do. And then every single role I got in out of college, 3 roles, were all from Holy Cross people helping me get the jobs. So I really, really think just try to focus on the networking piece at this age. That's something you can do now. You don't need to figure out what you want to do right now. So that would be a great first step.
Awesome.
Yeah, Jay, I was just trying to do the math in my head, and yeah, every single role that I have had in my career has had some sort of a connection to Holy Cross as well. And so I echo what all of us have said, which is just get out there, get to know people. But on the flip side, guys, I think taking the counter side, enjoy your time on the Hill. And I know we're saying that a little tongue in cheek of like, we wish we were in college again in some ways, but in all seriousness, developing that desire to learn, being curious, learning how to learn, which is the strength of a liberal arts college like Holy Cross, and frankly, building a social network and developing those deep relationships that will take you a lifetime, that will last a lifetime, that you're doing in the social experience of Holy Cross. That's how you build a career. And so cherish that, double down on that. You might be taking that random African history course that you probably will never actually use much of the information that you're learning directly in that class again necessarily, but you are going to take those repetitions of learning and studying and being curious and all of that along with you, no matter what you do, and your career will take you in wildly different ways than you ever could expect right now. So keep being curious, keep learning how to learn, keep having fun, and make sure that, look, we spend more of our life working than we do in especially many of these roles that we're discussing, such as investment banking. You're working 100+ hour weeks. You want to make sure that you're enjoying what you're doing or working towards an end game, and keep all of that in mind and meet good people. Holy Cross does a great job of creating a network of good people that are looking to help each other out. And so take that with you going forward as well.
That's some great advice. Just one really quick last question from Jack. He asked, does it make sense to take the GMAT now, or is there an ideal time?
My view is I would take it now if I could have. I wish I'd done it at Holy Cross. I think that frankly, an MBA wasn't on my radar, but I wish it had been earlier. And so if you have time, take it. It's good for 5 years. I personally believe the right time to get an MBA is probably around like 4 to 6 years. So right around the time that the GMAT is useful for. And the other thing I wish I had been familiar with is like HBS's 2+2 program, where you can actually apply to business school right out of undergrad, and then you have 2 to 4 years to attend. So that'd be my advice.
Thanks, Kelly. Yeah, students, if you have any additional questions for these alumni, you can absolutely reach out to them. Again, you can expect an email from me. But since we are just about at 8 o'clock, I just want to say thank you all so much for taking time out of your busy weeks and schedules to be with us tonight. I know that this information is really valuable for students that are here with us today, but also who will watch the recording. So thank you all, and I hope everyone stays safe and warm in the snowstorm tomorrow. So bye, everyone.
Have fun
Thank you.
tomorrow.
Everybody,
Wow.
everyone.
Thanks, everyone.
Enjoy.
Thank you. Have a nice night.